makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in Sintra for the ECB Forum. Now, we have a range of top interviews this hour, including the Bank of Portugal Governor Mario Centeno, the Apollo Chief Economist Torsten Slok, Chief Economist of the EBRD, Beata, Javorcik. But we start, of course, with the Societe Generale Chairman in just a second. Now, let's also take a look at the European markets map because, frankly, markets have been, if not wild, certainly interesting. Now, European stocks are actually declining. We do have a bit of Euro region inflation data coming. And this is after policymakers seem to be signaling that they need more evidence that price pressures are easing before considering another interest rate cut. We also spoke to Philip Lane, the chief economist of the ECB. Now, the president of the ECB, Christine Lagarde, says the bank does not yet have sufficient evidence that inflation threats have passed.
Facing several uncertainties regarding future inflation, especially in terms of how the nexus of profits, wages and productivity will evolve, and whether the economy will be hit by new supply-side shocks. And it will take time for us to gather sufficient data to be certain that the risks of above-target inflation have passed.
Now let's discuss all of this with Bini Smaghi. He's chairman of Societe Generale and former ECB board member. Mr. Bini Smaghi, as always, thank you so much for giving us a little bit of your busy schedule here in Sintra. This week feels different because there's a lot of politics and there's a lot of politics chatter outside the main conference center. But what does it mean for a bank like Societe Generale, given the election drama in France? How are clients feeling?
Well, I mean, we have to wait for the election. Clearly, there's more uncertainty than 1 month ago. People are maybe waiting to see the result of the election. It's just one of the many elections this year. We have one later this year, which is maybe as important. I think this adds to the uncertainty, and we have to navigate through this and manage risks. And I think we're helping our clients to do that.
Are clients having more transactions ahead of the second round of the election, or has there been any change in their behavior?
Well, what we see is increased volatility in the markets, and clearly this is to be expected, and we try to manage that. I think in terms of investment, of consumption, behavior of our customers, I think they're waiting to see what the outcome is. There are so many divergent possibilities that I think is, for them, it's better to wait.
I mean, the market have been quite volatile because they worry about fiscal expansion or something that, Liz trusted, that's not actually funded, but huge fiscal changes. Mm-hmm. Is it something that monetary policy could fix if they needed to because of the widening spread between the French and German bonds?
Well, I think the ECB has its own tools. Clearly, there are conditions to these tools. One thing is the election promises, and the other thing is what will happen after the elections. And I think everybody has in mind the Liz Truss experiment. It happened in Italy and hopefully in France also. So I think one has to see that the markets are going to make their own discipline in any case, and the ECB is there to do what it has to do. So.
But we heard from the German finance minister that if the ECB were to intervene, he'd call it illegal. I mean, what do you make of those statements? Pretty strong.
Yeah, I think it's quite shocking, actually, because to have a finance minister who tells ECB what it can do and cannot do, I think it's a violation of the treaty, actually, because ECB is independent. So it's coming from a German finance minister, it's really surprising, because the treaty says that politicians should seek to avoid putting pressure on the ECB. So I think the ECB knows what it has to do, and one should not, I think, fall in the temptation to try to gain some votes. We know that there are elections next year in Germany. I don't think the ECB should be part of this discussion, frankly.
But do you think this is what's happening, that it's basically, ministers or non-ministers just try to get votes almost at no matter what cost?
Well, there is a risk, because otherwise I don't understand why at this stage a finance minister should tell the ECB what to do. It can comment afterwards, but threaten the ECB of going to courts. Actually, past experience with the German courts suggests that the ECB was always right. So I don't think it's a good idea if I can give any advice to the German finance minister, think about your own problems. you have enough, I think, in Germany.
You're, of course, chairman of one of the biggest banks in France. Do you worry about this widening spread?
I think the markets have reacted slightly, and I think we are not concerned. I would say clearly the markets are doing their job. They're assessing risks, and I think those who will be in charge will take this into account. And of course, there are challenges ahead for all European countries. Growth is a key challenge. Competitiveness, if you compare it to the US and to other parts of the world, Europe needs to grow, need to find the right balance in terms of fiscal adjustment. And experience of the past suggests that if you diverge too much, then you will be confronted with the problem of loss of credibility. So I think we are confident that this mechanism will work in terms of discipline.
But overall, what do you see in Europe at the moment? There's a lot of protest votes, and I don't know whether it goes to, consumer sentiment, it goes to the economy, or it goes to something deeper that you can also pinpoint when you look at, some of your Slok Gen clients.
Yes, well, Europe is in a situation in which growth is certainly not the same as in the US. Although we are close to full employment, but wages are not growing as fast, so people feel penalized by the inflation, which has, is coming down, but still has penalized people, and they don't see what the solution is. So there is a temptation, and the elections in Europe have suggested that people would like to have more national solutions, while clearly, as economists, we know that if we compare ourselves to the US, what's missing is a large, big integrated markets, like a European capital market, a European energy market, all these areas where Europe is small. And so in order to compete, we need to work more together. But politics are local in Europe, and then people tend to blame the national politicians for not taking care of their national economies. But in fact, what we should have is more Europe, more European policies, more European coordination. So this is a dilemma, I would say, between how people feel and what is the optimal, ideal solution to be competitive in the global economy.
So if there are more inward-looking politicians that are elected, what does that mean for European growth? And actually, what does it also mean for the banks?
Well, in terms of markets, it means that it's going to be more difficult to have a true European capital market, a true European banking market, a true energy security. Then people will have to realize over time that maybe they were wrong in choosing more local policies, and that we need more European policies. But as in all democracies, you need to realize that maybe you have to change the choice that you made some years earlier. The important thing is that the institutional setup is there to make sure that we will still be able to vote 4 years from now, and that's democracy. And it's not necessarily the case, and we've seen in Italy that a government which comes in with an agenda which is maybe more nationalist, over time doesn't realize that you need more Europe to treat immigration, for instance. In the end, I think the government and we all realize that within a single integrated area, having different national policies doesn't make sense. So over time, there is an educational process that will lead governments to, I think, to understand that only European policies are effective to deal with the issues that the people are concerned with.
Lorenzo Bini Smaghi, thank you so much for joining us. I was the chairman of Societe Generale and former ECB board member. Now, coming up, we talk politics, U.S. politics. The U.S. Supreme Court rules that Donald Trump has some immunity from criminal charges over his attempt to overturn the 2020 election result. What that decision means for the election, well, that's next, and this is Bloomberg. So the European Bank of Reconstruction and Development has earmarked 300 million euros to help Ukraine overcome a critical shortage of electricity as a third winter in wartime approaches. Now let's discuss all of this, but also her outlook for the Eurozone inflation, EBRD's chief economist, Beata Javorcik. Beata, thank you so much for joining us. I mean, first, it seems that politics is really overriding anything to do with the economics, but that touches what you need to do and step in for Ukraine. It also touches the kind of volatility that we're seeing in the markets. What do you worry about?
Well, first, I worry about Ukraine, and in particular about the energy sector in Ukraine. 70% of electricity generating capacity has been destroyed. So here we are stepping in, trying to finance, help rebuild, in particular to rebuild distributed generating capacity so that Ukraine can make it through the winter.
So is there a worry that actually because of the political divisions, because of the political factions in Europe, it's going to be harder for Ukraine to be supported longer term, as I guess, countries look inwards?
Well, we are committed to continue supporting Ukraine. We have received capital increase. So under war conditions, we expect to deploy between 1.5 and 2 billion every year. During reconstruction phase, about 4 billion.
We look at the French elections. There's been quite a lot of drama, certainly playing out in the markets. Could it really change the trajectory of the Eurozone?
Well, political uncertainty matters before the outcomes, the political outcomes, the new policies are revealed. Think about Brexit. After Britain invoked Article 50, nobody really knew what shape the post-Brexit relationship would take. And yet already at that point, we saw decline in online job postings in local labor markets, which were going to be exposed to barriers to services trade. We saw lower investment. We saw lower entry of firms into exporting to the EU. So uncertainty matters, and it's not just the actual policies, but the expected policies that have an effect.
So is that a way of saying that actually markets have almost front-run some of the uncertainty by placing bets? Then, will there be less volatile come Monday morning?
Well, volatility may remain, but markets are already incorporating some expectations about what the outcomes of the elections will mean not only for policies of individual countries, but also for European policies. And let's not forget geopolitics. Sadly, the world is on a path to fragmentations. We see more and more trade barriers because policies on trade are not made by ministries of trade or ministries of economy, but rather by ministries of foreign affairs. So they are driven by politics, not economic considerations.
Do you see monetary policy changing because of these elections?
Well, I don't envy central bankers because the shocks they need to take into account can work both ways. On the one hand, Donald Trump is promising an all-around tariff in the US that could slow down European exports and European growth. On the other hand, the war raging in the Middle East could lead to higher oil prices that would fuel inflation. So policy making, particularly when it comes to monetary policy, is incredibly difficult these days.
Do you think it's been more difficult than in the past because of these? I mean, these are just the concerns that we know about.
Exactly. And then, but even the known concerns are still difficult to assess. Think about critical raw materials. Green transition means we need lots of minerals. Building an electric car requires 6 times in terms of mineral inputs as building a conventional car. And a lot of production of those critical raw materials is concentrated in China. Should there be escalation of geopolitical tensions, Europe may find itself scrambling for some of those raw materials.
So I've always heard that actually Europe doesn't have a robust enough energy policy to speak with one voice and lead us to the future. How does that get fixed?
Well, that's not just the energy policy, right? When you think about critical raw materials, Europe is striving to find alternative ways of supply. The problem is that an export restriction can be introduced at the stroke of a pen, while developing new sources of supply takes more than a decade.
So how do you fix that? Again, what's the right way of Europe dealing as a chief economist? When you look at the transition, what's needed also in terms of power, in terms of data, what should our policies be?
More cooperation. We definitely need more cooperation at the European level, because what gives Europe strength is the single market. And that's the best bet Europe can make in order to accelerate future growth. Deepening of the single market is the answer. You know, we did a study looking at how much Eastern European countries benefited from their EU membership. And the answer is half of the catch-up they have achieved was due to the EU membership. At the same time, Western Europe sailed through the financial crisis in a less severe way because of that Eastern European market.
We're just talking to Lorenzo Bini Smaghi, the chairman of Societe Generale, and he was also saying, look, no matter what happens with politics, if it's politicians that are in charge that are more inward-looking, that puts in question the capital markets union, puts in question, you know, a lot of unions that could happen with the EU. What does that mean to growth, and what does that mean to employment?
Well, the best way of stimulating growth and employment is to continue with the European project. And again, Brexit is a good example of how increased barriers, and in particular barriers to services, can have a detrimental impact on employment. So we need more cooperation rather than less, in particular on issues such as not only energy security, but also energy transition and grid transition.
I mean, Europe is also between, you know, the U.S. and China, and we talked a little bit about that, what that means for critical minerals and you know, politically being set in the middle. What does it mean for inflation? Are we importing deflation from China and importing inflation from the U.S.?
Well, there is a danger that if Europe follows the U.S. and escalates trade tensions with China, we are going to introduce trade barriers which will increase inflation. But this fragmentation, this war, potential conflict with China could actually be detrimental to European growth. Let's not forget that Europe is much more dependent on exports and foreign trade than the US. So potential Chinese barriers would hurt us more than they hurt the US.
Beata, thank you so much for joining us. As always, that was the EBRD Chief Economist, Beata Javorcik, joining us from Sintra, Portugal. We also spoke to Austin Goolsbee, Chicago Fed President, and a little bit earlier on we're speaking to Philip Lane. Plenty more to come from Sintra, and this is Bloomberg.
Yes, I think the first two rate cuts are relatively easy as long as inflation, say, hovers around 2.5, because we would still clearly be restrictive. If we are still moving around 2.5 and contemplate other cuts, I think at some point it becomes more difficult. So we would really need to have strong indications that we are moving below 2.5 to 2%.
Well, that was the European Central Bank Governing Council member Pierre Wunsch there speaking to Bloomberg. Now, a fraud suit against stocks influencer Keith Gill has been dropped within days of its filing. A GameStop shareholder had accused Gill, also known as Roaring Kitty, of engaging in a pump-and-dump scheme. Now, it's unclear why the suit was dropped. Gill was one of the faces of the 2021 meme stock craze and re-emerged in May with new posts about holdings in GameStop. General Electric has agreed to keep Chief Executive Larry Culp in the top job at the aerospace manufacturer until at least 2027. The extension comes after Culp orchestrated a multi-year turnaround of the former conglomerate, culminating with the spin-off in April of its energy-related businesses. Well, that left GE Aerospace, the world's largest maker of jet engines, as a remaining company. Northern Data is said to be considering an U.S. IPO of its combined AI, cloud computing, and data center businesses. Now, the potential listing could fetch a valuation of as much as $16 billion and is targeting a debut on the NASDAQ as early as next year. Well, sources say Northern Data may also sell a minority stake in the unit to investors ahead of the listing. Now, in other news, Paramount shares jumped and in extended trading after a New York Times report that billionaire Barry Diller is exploring a takeover bid. Well, Diller's digital media conglomerate IAC has reportedly signed non-disclosure agreements with Paramount's controlling shareholder, National Amusements. Well, Diller's interest comes after a takeover bid by Skydance fell through. And Hurricane Beryl has reached Category 5 strength as it heads across the Caribbean for Jamaica. That's the earliest point in the year that an Atlantic storm has reached that strength. Now, the U.S. National Hurricane Center says maximum sustained winds have increased to around 260 kilometers per hour, with gusts even higher. Well, coming up, we have a lot of interviews here from Sintra, Portugal. Our interview with the Bank of Portugal Governor Mario Centeno. This is, of course, at the ECB Forum. We also heard from Christine Lagarde. She gave a speech yesterday to really kick us off. And we also spoke to Philip Lane a little bit earlier. The main takeaways is that it's a little bit too soon on what they cut next, but it seems that both actually took July off the table. We also speak to Torsten Slok, chief economist at Apollo. All of that and much more coming up from Sintra at the ECB Forum. This is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in Sintra, Portugal. Now, investors are watching for your area CPI inflation due out in the next half an hour. Let's take a closer look now at the outlook for the ECB with Mario Centeno, the Bank of Portugal Governor. Governor Centeno, thank you so much for joining us. Congratulations, first of all, on the football. We're here in Sintra. I have to say the room was quite hectic and looking for the penalties, but you've made it.
Well, thank you for having me. Both teams were brave, but at the end, Portugal prevailed.
Portugal got it. Could you be as confident on the Eurozone economy? There's a number of headwinds, including politics in France. Does it complicate how you set monetary policy?
Well, let's take a little bit of a longer perspective. On the one hand, our baseline is solid. Inflation came our way actually faster than expected. After big crises as COVID and then this inflation process, I think we must be moderately proud of ourselves in the sense that inflation is about to close to 2% in our forecast horizon, very well anchored. The economy, we have a positive surprise in the first quarter of 2024. We must build on that.
And the ECB cuts, and it was fine, it was well telegraphed, well received by the markets. How many more cuts do you think there will be this year?
Well, that's a different story. I would rather prefer to see things as we move. Again, if the baseline is solid, there are still headwinds, as you mentioned. And we must build on our successes. The labor market is very important for the European economy these days. It's the pillar of stability in our economies. So we need, as policymakers, to also contribute to this smooth transition. We call it soft landing. But soft landing is not a normal status in such a high pressure financial conditions that, of course, the interest rate hike generated. So I expect a few more rate cuts this year. We think that we need to follow the meeting by meeting strategy, and hopefully the data continues to come our way.
So, Governor, are you worried that actually a soft landing is not a given? That I guess it's the base case, but there's a number of things that if you calibrate wrong, could go the other way.
That's always something that we need to be concerned with. And given how much of these hinges in the labor market performance, on this very high level of employment, low unemployment, great dynamics in our labor market, we all hope, and this is the baseline, that this will continue. Our forecast is a lot sustained by consumption increase. This requires real disposable income also to increase. Real wages have to catch up from the reduction that we observed during the last couple of years. For all of these to be materialized, we need also policy and monetary policy to contribute to.
I mean, the market was hoping for some kind of guideline, I guess, on how interest rates will go down further. Mm-hmm. There seems to be an assumption from Christine Lagarde, but also from Philip Lane, that probably you need a little bit more to cut again. So is July off the table for an interest rate cut?
Well, from our methodology perspective, not. We need to see how inflation numbers will come up in less than half an hour. The country numbers all are in line and slightly below, actually, the forecast. Let's see what we have. But take always a longer perspective. That's my point. We need to know where we come from. Very difficult situation, very successful in terms of policy in Europe. It was not only monetary policy. We need to share this success with workers, firms, governments, because fiscal policy in Europe also played much more moderately pressures on prices than in the US. So this was a collective match, as any soccer match plays down, and we need to continue this into the future, being prudent and confident. Those are the two words.
Governor, what are you most prudent about? Again, and I know you don't want to talk too much about what's happening here and now, but you had quite a sizable, widening of the spread between Germany and France. Are things like that worrying for you?
Again, for that, we need to call into action the old framework that we have in Europe. We have a very strong and sustained fiscal orientation in Europe. We have a new version of the Stability and Growth Pact being applied since this year. That's a big issue for Europe, of course. We all have to have an eye on that, but we have to play collectively again. So I think every part of the game will do its own job, and I'm very positive that we will be able to make it.
How does U.S. Fed policy, or the U.S. in general, actually impact your thinking of what kind of growth we'll see in Europe and what kind of inflation we're importing?
We live in a global world, so we were very lucky to be highly synchronized in terms of monetary policy in the last couple of years. We want to continue that level of synchronization, but we need to look at our numbers. And the numbers in Europe differ from those in the US in different perspectives. It's not only inflation that looks set to fall faster in Europe than in the US. The US economy is growing more than the European one, but you must remember the fiscal stimulus that there was in the US, and also the push through consumption that the US had and Europe didn't. So we need to look at in the global context. If I am to say, as an European, I think the path of European growth and policy-wise was more stable and sustainable than in the US. I mean, we did not have the big fiscal stimulus that the US had. We managed to cope with COVID in a more solidarity way. We issue a common debt in Europe, which was something that was out of the cards for a long period.
Happy with how Europe handled it?
Yes, on that I am very positive. And we need to communicate this also, because our citizens, of course, suffer the challenges and the uncertainty that the global difficulties that we see, wars, and we have a war in Europe. We sometimes forget about it. And we have to fight it, and we have to win it, of course.
Governor, talk to me a little bit. The commercial real estate, but also in general, private credit is something that's worrying, central banks. Mm-hmm. Are you worried about the shadow banking, the things that's not regulated?
I mean, we, again, in that perspective, in Europe, the monetary policy transmission was very forceful. Credit has been almost flat in nominal terms, which means that in real terms it's really falling. We have our bank supervision playing out, in which we evaluate very positively. there are always challenges around those subjects that you mentioned, and we need to keep an eye on them as always. But so far, again, if you look the banking sector, the trouble that you saw in the U.S., this issue of Credit Suisse, we didn't have anything like that in the euro area.
So you don't think there's something ugly coming that could be systemically important?
Not in the baseline, and the baseline again is solid. We need to do scenarios for risks and headwinds that sometimes may be ahead of us, and we need to be prepared to deal with them. But I will remain very positive and very open, meeting by meeting, to do whatever is necessary. Also to contribute to this positive tone that, again, our citizens need to listen from us policymakers, because we are here to be cautious, to be prudent, but also to send positive messages.
Mario Centeno, thank you so much for joining us. That was the Bank of Portugal governor. Now, we'll have plenty more from Sintra, Portugal, throughout the day. Coming up, economics also in focus ahead of the U.S. jobs report on Friday. We'll be speaking to Torsten Slok, partner and chief economist at Apollo Management, here at the ECB's Forum in Sintra. This is Bloomberg.
Second half of last year, in the U.S., we had 7 straight months of excellent inflation. We hit a bump in the road in January of this year, but now we've gotten a string of improved inflation readings. If we get more like what we have just seen, to me, that feels like the path to 2%.
Well, that was Austin Goolsbee, the Fed Chicago president, on promising U.S. inflation readings, which could then lead the Fed to make rate cuts. Now, I sat down with him a little earlier here at the ECB Forum in Sintra. Now, joining us now to put all of this together, we talked, of course, about Europe. We talked about the U.S. Here with me in Sintra is Torsten Slok, partner and chief economist at Apollo Management. Torsten, I've been trying to speak to you so long. You see, I have to show up at the ECB Forum to make sure that I get your perspective on things. We just heard from Austin Goolsbee. We also heard from Philip Lane. If you put everything together, there does seem to be a little bit of reticence to actually cut interest rates. They're so data dependent or data point dependent.
Yeah, I think that one conclusion, at least from the conference here and from also what you've been talking to people about, is that I do think that we in markets need to think of this as rates are going to stay higher for longer. In the US, of course, we've been through quite a roller coaster ride this year, expecting a lot of cuts, then fewer cuts, then more cuts, and now fewer cuts. In Europe, also again, earlier this year, a lot of cuts were expected. Now the market is talking about 1, 2, maybe 3 cuts in the most extreme case, but much fewer cuts than what we had expected earlier this year. So I think higher for longer continues to be the dominant theme.
But Torsten, is that a problem for the Fed? I mean, we've heard a number of outside economists, including Mohamed El-Erian, saying, like, look, if you wait, then you could potentially see more problems in terms of risks.
Well, that raises exactly a very important debate about why is it that we need to keep rates higher for longer? What are the tailwinds that are keeping growth so strong, not only in the US, but also in Europe? In the US, you have 2 very special idiosyncratic tailwinds, namely, number 1, we still have strong fiscal support. The CHIPS Act, the Inflation Reduction, the Infrastructure Act are still fiscal policies that will support GDP probably over the next several years. The second thing also the US has as a tailwind is very easy financial conditions. The stock market continues to go up because of AI. That gives strong investment in AI. That gives strong wealth effect from the stocks in AI going up. All this is also a very separate, very significant tailwind in the US outlook. And that tailwind is also spilling a bit over to the European outlook. The data has been surprising a little bit more up to the upside, and still easy financial conditions in Europe also providing enough support. Probably, again, the main reasons why the economies, both in US and Europe, continue to actually do quite well.
Torsten, I mean, some of the other things that we explored, for example, with Austin Goolsbee, is this idea that, you know, when you look at consumer sentiment, it's been politicized. And so I guess the surveys may not be as reliant as they used to be in the past. Does that just put more emphasis on employment and therefore the employment number on Friday?
Yeah, because the Fed has a dual mandate of both inflation at 2% and employment. The ECB has a clear only one mandate, namely inflation. And what's exactly right, Francine, is that in the US you've seen especially inflation expectations show a very distinct pattern where you're seeing inflation expectations in the median are very stable at 3.1% over the next 5 to 10 years. The median voter thinks that inflation will be stable in the long run. But the mean of inflation expectations is much higher at around 7%. So that means that you have half of the population in the US having inflation expectations that are much, much higher than the other half. And that is indeed creating a lot of debates around what is consumer sentiment, what are inflation expectations, and therefore what is the broader narrative that is told in terms of one part of the population relative to the other part of the population.
Torsten, what do you see as the biggest risk out there? We talked about commercial real estate with some of the participants. We talked about private credit. We were talking about inflation. But is there something that we have not thought about?
Well, I think some of the things that you also just spoke about with Centeno, namely that we have still issues with commercial real estate. It's still a risk, in particular in the US. But it is still the case with work from home that office occupancy rates continue to move higher. At the same time, interest rates higher for longer. It's just a bad cocktail if you both have occupancy rates that are relatively low compared to historical levels, and at the same time you also have interest rates that are higher. So one area is certainly commercial real estate is a problem, not only in the US, but also in Europe. Another area where you also have some problems, of course, is still geopolitical risk, and for that matter, political risks, both sitting here in Europe, but also in the US. A lot of uncertain things that are now beginning. Yesterday, it did begin to maybe matter a little bit more in markets in the US, the election, but a lot of these things may become, over the next several months, a very important factor when markets begin to talk about, well, should the yield curve be steeper? Are there risks in terms of the fiscal outlook, not only, of course, when it comes to France and Europe, but also when it comes to the US?
I mean, should we, or could we, after the US election, be talking about a possible interest rate hike depending on some of the fiscal policy put in place?
Well, at least for now, markets are pricing just, of course, a cut here potentially in September and then another cut in December in the US. So we both have 2 cuts priced at the ECB and 2 cuts priced at the Fed. But it is very clear that both with the French election and also with the US election, that it remains to be seen what policies come out on the other side. And if, of course, politicians, not only in the US, but also in Europe, decide to do expansive fiscal policy, more tailwinds to the economy, on top of the tailwind of easy financial conditions, and on top of the existing tailwinds from easy fiscal policy, that could, of course, open up conversations about, well, maybe rates need to stay higher for a lot longer than what markets currently are pricing. So that's why we have been saying for quite some time that we don't think the Fed will be cutting rates this year, because we do still think that the tailwinds to growth are quite strong.
Torsten, it's very clear the policymakers here in Sintra were shying away from talking French politics and saying, it's an election cycle, it's normal, even the widening of the spreads is something that we're used to. How do you view it? Could it actually change a monetary policy in the Eurozone, but also growth trajectories?
Well, I think that, it is very early. We need the second round. I still think that the baseline for the ECB is likely not changed on the back of anything that has happened up to this point. But it's pretty clear that the people you have had sitting in this chair earlier today think probably a lot about what the consequences might be. And the difficult challenge for everyone, including us in markets, is how do you quantify these different political risks? We all have a very nice little spreadsheet where we forecast, here's what inflation will be, here's what unemployment will be. But how do I put into my model these various aspects of political risks, both in Europe and in the US? It just becomes really difficult to get a quantified measure of how much the impact will be, even on, of course, on the fiscal front and ultimately on GDP and on inflation.
And so what kind of metrics do you look at? Again, is it fiscal spending for France and is it fiscal spending for the US, or is it something else?
Yeah, well, that's why I think there's something else really is the data dependency, and therefore figuring out, is the incoming data behaving as the central banks, as the ECB and as the Fed have been predicting, or are there signs that it's actually a little bit better, which has been both in Europe and in the US in the last several months. So if that's the case, well, maybe we're not quite seeing that slowdown, and maybe therefore the data dependency is coming back. That's been coming back, of course, for the Fed especially, but also for the ECB, focusing on is the incoming data behaving as their forecast would have predicted.
And China predictions are also quite tricky.
Yeah, because China, of course, also has a lot of challenges with both demographic headwinds, with the housing market that's deflating. You also have exports are falling. And those things combined also, of course, probably mean that housing growth especially will be putting downward pressure on growth in China for, in our view, probably the next several years. And if that's the case, that's of course going to hurt German exporters that export to China. And that's also going to create a lot of other ripple effects across, especially emerging markets. And therefore global growth from the impetus of lower growth in China is probably going to get a negative impact. But that's why that's being offset by easy fiscal policy and also easy financial conditions.
Torsten, thank you so much for joining us today. That was Torsten Slok, partner and chief economist at Apollo Management. Now, we'll have plenty more, of course, from here throughout the day. Coming up, the ECB's chief economist says June inflation will not be enough to move the dial on interest rate cuts. Our exclusive conversation with Philip Lane. That's next, and this is Bloomberg. Now, the ECB's chief economist says June's inflation data will not provide answers to the bank's lingering questions on underlying price pressures. While speaking exclusively here in Sintra, Philip Lane signaled that a July cut is unlikely.
We're in mid-twos, and what we said in the June projection, essentially we're going to be in mid-twos into early next year. But then I think there's a lot of foundations in the movement from this year to next year to see inflation come down to our target in the second half of next year. And I think what we've seen the last day or two with the early indications of the June inflation data is in line with that assessment.
But is it too early to cry victory? And so what does that look like in terms of future interest rate cuts?
So I know it's a very natural question to ask, and what I've said before is under the baseline projection in June, of course we're not going to remain where we are. Now, we have essentially 8 meetings between now and this time next year. This time next year, again, under the projection, we're going to be looking at the second half of 25 at targets. So clearly, being at target and having an interest rate of 3.75 is not where we're going to be. But the exact timeline will depend, I think, as President Lagarde said in the speech last night, essentially looking for extra confidence about the, if you like, the remaining disinflation we need to do. And the key issue there is really services inflation. And what we've seen in the last day is essentially services inflation remaining the outlier. It remains relatively elevated. And what we need to see is that relatively high services inflation just a backward element? It's a legacy of the rapid disinflation that it's still working its way through services inflation, or is there any persistent element? And I think right now we need to take a little bit of time to work on that.
Well, that was the ECB chief economist Philip Lane speaking to me here earlier in Sintra. Now, here's what to watch for today. First of all, Euro area CPI in just a few minutes. We also have the U.S. jobs data a little bit later today, and of course the ECB Forum, where I'm at here in Sintra. We'll hear from Christine Lagarde, Campos Neto, and of course Jay Powell a little bit later on. Up next, Bloomberg Brief with Danny Berger and Manus Krani in New York, and this is Bloomberg.